Well, good afternoon, everyone. I'm Alex Thompson, the Head of Capital Markets for iPartners, and welcome to iPartners Talking Alternatives, where in this session, we're going to deep dive into the Australian banking sector. This aligns with the current investment opportunity we've structured for our investors to take leveraged equity positions in order to capture dividends, franking credits, and potential upside from listed bank stocks. Dividend capture strategies can provide an alternative investment approach to income-seeking investors when they're properly structured. So for those new to iPartners, we're one of Australia's leading alternative asset investment platforms, providing self-directed wholesale investors access to institutional grade alternatives. We offer our investors access to a range of alternative asset classes, including private credit, private equity, real estate, and listed alternatives. So as we begin, I'd like to welcome our guests today, Michael Blythe and Mark Sherwood. Michael is a highly respected chief economist with a deep understanding of the economy, economic policy, and financial markets. He was the chief economist of the Commonwealth Bank of Australia for close to 25 years, as well as having previously worked as a senior economist for the Reserve Bank of Australia through the 90s. It goes without saying that Michael brings great knowledge and insights into economics and the financial markets. So we're pleased to have Michael with us today. And Mark Sherwood is Director of Capital Markets here at iPartners. Mark has over 20 years experience in investment markets across a broad range of asset classes. Mark has held senior roles at Westpac's private wealth business, where he led teams of investment directors providing advice to high net wealth investors. Prior to Westpac, Mark worked across the Asia region for several investment banks, including Credit Suisse, TD Securities, and ANZ Investment Bank. Mark's broad asset class experience includes various roles across fixed income, equities, ETFs, private debt, and private equity, as well as institutional real estate. So thank you both, Michael and Mark, for making time to take part in our Talking Alternatives session today. Prior to the session, we reached out to our investors and asked them to let us know what they'd like to hear more about, and we've tried to incorporate those questions into today's session. If there are questions from the audience along the way, please submit them through the portal, and we'll have time for Q&A at the end of today's session. So coinciding with this discussion today, iPartners are providing an opportunity for investors to take leveraged exposure to ANZ, Westpac, or NAB stock with limited downside risk as a dividend capture strategy for income-seeking investors. The iPartners limited recourse equity loan provides investors with a tax-effective leveraged exposure to bank stocks with controlled downside risk. After Michael completes his presentation today, I'll ask Mark to make some comments about the structure of the leveraged equity loan solutions and how they can be used to capture potential upside returns. But before we do that, Michael, would you mind providing us with an overview of the Australian banking sector?
Sure. Thanks, Alex, and good afternoon, everybody. I suppose when we think about the banks, they are one of those kind of groups of really sort of polarizing organisations. And we tend to love them or we tend to hate them. Most people kind of fit into one of those camps. But I think one thing that everybody agrees are that the banks are an essential part of the economy. And they're also a part of the economy that has the power to kind of magnify economic shocks or help prevent those shocks from impacting on the broader economy. And certainly, if we rewind the clock to the first half of last year, when the pandemic and the economic fallout from the policy response was starting to hit the economy, that was clearly an issue that the policymakers were very worried about. And a lot of the policy at the time was directed into making sure the financial system and the banks kept working. So I thought I'd kind of start with just a kind of big picture of how that was playing out across the economy. And you can see that on the chart on the left-hand side here, where the green line is just the ASX 200 banks index. The black line, though, it's a measure of what's called policy stringency, put together by the University of Oxford. So it was basically a measure of just how stringent our policy response was to the pandemic. So it measures things like lockdowns, social distancing, all those sort of things that we had to do. Plotted upside down, so as that black line falls, policy was becoming more and more stringent. And certainly, when you look on the left-hand side there, financial markets were pretty quick to price in the worst case scenario, as that policy stringency increased, bank share prices fell a long way. as we kind of move across the chart there, as restrictions were eased and tightened again, all those various occasions, we tended to see the bank share prices move in the same direction until you get to the end of the chart there, where we went into that kind of second wave, the lockdown in New South Wales and Victoria and so on. And while bank share prices didn't keep rising, they certainly didn't fall the way they did right at the start of this process. So I think that tells you something about the underlying resilience of the Australian financial system and the banks. And it also tells you that we're probably kind of too pessimistic in our initial views how the pandemic story would play out, particularly for the banks. Now, it's not to say the banks weren't hurt in some ways, and the chart on the right-hand side shows you what's happening with the banks' loan performance. So we did see in the first half of 2020 some increase in the share of non-performing loans. We did see an increase in loan arrears and the like. But the damage was fairly limited, and as you move across that chart, we've actually seen those measures improve more recently. So again, it just kind of highlights the point, I think, that the banks have done pretty well in what have been very difficult times for them, as well as the rest of the economy, of course. And bank profitability did reflect these sorts of trends. So again, the banks weren't immune to what was going on. And we move over to this chart, which shows you what's happening with bank profitability, where you can see the big dive that occurred towards the end of the chart there. Partly because there was a big increase as prudent banks increased their provisions for losses and the like. And in fact, as you can see, the increase there towards the end of the chart was getting towards the sort of levels that we last saw during the GFC back in 2008 and 2009. So bank profits were hit. But as it turns out, because outcomes were better than expected, because the banks were resilient, those provisions weren't actually needed. And now they're being repaid, if you like. They're going back into bank profitability. And the return on equity that we're seeing in the banks right now is pretty much back to where it was pre-pandemic. And if you can make out that dot on the right-hand side of that chart, that's based on the next 12-month forward earnings expectations, where the return on equity will be over the next year. So pretty much where it is right now. As I've alluded to a couple of times, these sort of outcomes, I think, just reflect the fact that the economy wasn't hit as hard as people were expecting at the time. There was a quick recovery after the initial lockdowns came to an end, and the financial system was resilient, courtesy of all the sorts of changes that the regulators had put in place since the GFC. That's an important point to note, I think, when you're thinking about the Australian banks. Hopefully, like most of us these days, they were double vaxxed, if you like, by some of the changes that the regulators put in place. And in particular, as you can see on the chart on the left-hand side here, the amount of capital the banks now have to hold has been increased substantially. The way to think about this, the kind of a minimum amount of capital globally that the banks have to hold in a tier one sense is around about 4% of assets. Our banking regulator, APRA, though, wants the Australian banks to be what they call unquestionably strong. And that means they want the Australian banks to hold a minimum capital ratio of 10.5%. The reality, though, when you look at this chart, is that the Australian banks are holding well above what even that unquestionably strong level set by APRA is. Likewise, the regulators have forced some changes in the way that the banks fund themselves, and you can see that on the right-hand side. And Australian banks are overwhelmingly these days funded through domestic deposits. Now, regulators like those sorts of deposits because they tend to be sticky. They don't disappear in a financial crisis. They remain in place. Of course, what's that allowed is that the bank exposure to relying on wholesale funding markets in terms of their long-term and short-term debt, as you can see, has actually gone down. So we're now kind of less exposed to those risky wholesale markets that can, on occasion, just stop working during financial shocks. So, now again, it's something that's improved the security and stability of the banks and the Australian financial system. Now, all through this period, the regulators, the Reserve Bank, APRA again, they've been trying to blow up the Australian banks, not literally, but by conducting a never-ending series of increasingly tough stress tests to see how the banks would survive against all those kind of worst-case economic scenarios. And the good news there is the banks have passed pretty much every one of those tests with flying colours. And you can see here the results of what has been the most extreme stress test applied to the Australian banking system so far. And that stress test is what they call the severe downside scenario. It assumes that the Australian economy shrinks by 15%, that the unemployment rate rises to over 13%, and house prices fall by more than 30%. So I think we can all agree that is a pretty extreme set of assumptions and very extreme set of stresses to put the banks under. Of course, what happens is it does eat into some of the bank's capital. You can see the results of the stress test on that particular chart there, but at that kind of 6.5% rate, it's still well above the minimum level of capital. Of course, banks make losses under this scenario as well. But again, it really just underlies the point that I keep coming back to, and that is about the resilience of the financial system, courtesy of all those changes that we've put in place. And of course, with an economy that should be recovering over the next year, that kind of severe downside scenario looks unlikely. There are also some issues on the funding side of the equation that are worth thinking about as well, and you can see a couple of those here. Now, part of the reason the banks did remarkably well, or proved to be resilient to the sort of shocks that were hitting them during the pandemic and the lockdowns, of course, is that the Reserve Bank provided them with a lot of very, very cheap money. They introduced this thing called the term funding facility that basically allowed the banks in total to borrow $182 billion. That's about 4% of their overall funding, and they could borrow it at 0.1%. Now, this is great business. You can borrow at 0.1%, and then you can lend out in the home loan for 2.5% or more. So this is very important in helping the banks. It explains why interest margins held up pretty well. But all good things come to an end, and this term funding facility has closed. And when we get into 2023 and 2024, the banks are going to have to repay that money to the Reserve Bank. A couple of points here. That's still a couple of years away. And certainly the liaison from all the banks is they don't think they'll have any trouble at all at repaying that money, replacing with alternative funding when the time comes. But clearly there is an issue there to watch on the refinancing side. The other thing I want to say a little bit about that impacts not just on the banks but on financial markets more broadly is what you can see on the chart on the right-hand side there. And it shows you what's happening with Australia's current account position. And basically, after about 200 years of running a deficit, we're now running actually quite large current account surpluses. I actually wrote about this in a piece for iPartners a couple of months ago. But the point about this chart is the current account balance measures our exposure to global funding markets. When you're running a deficit, you've got to keep borrowing from the rest of the world all the time. When you're running a surplus, you don't. In fact, you can be a lender to the rest of the world. So our exposure, again, to those kind of global wholesale funding markets in particular that the banks used to rely on is now pretty minimal. We're not going to have much of a problem if those funding markets shut for some particular reason. So that cuts across all financial markets. And the only other point I'd make about countries that run current account surpluses is that they tend to have lower interest rates on average than countries that run deficits. And they also tend to have stronger currencies on average than countries that run deficits. So this current account story is definitely an important issue when you're thinking about the Australian financial system more broadly. What should we be watching in trying to assess where the risks may be developing for the Australian banks? Well, there's a a couple of areas that I think are worth looking at. One of those is the chart you can see on the left-hand side. This is an early warning indicator of financial system stress that's put together by an organisation called the Bank for International Settlements. They kind of regard it as the central banker's central bank, if you like, so they're a very exclusive club. But their idea is that what gets the financial system into trouble is when you're going through periods of rapid growth in credit, and where that credit is getting a long way away, if you like, from normal levels. Now, I highlight this one in particular because one of the developers of this indicator was, in fact, Phil Lowe, who's the governor of the Reserve Bank of Australia here. You can be pretty assured that he spends a lot of time looking at this particular indicator when he's thinking about financial system stability. Of course, look at that chart right now. That indicator is in negative territory. We're a long way from the big positives, again, that we last saw back at the height of the GFC. The financial backdrop, financial system stability looks pretty benign on that measure. If we're thinking about the banks in particular, though, well, what we all know is that a lot of their exposures are to the property market. A very large share of their books is out there for residential lending, as you can see on the chart on the right-hand side. And also for commercial property as well. So, that's where the real exposures of the banks to the economy lie right now. Now, we shouldn't really be surprised that the regulators and so on tend to worry about this the side of the economy. I mean, the one thing we've always known is that if you cut interest rates and if you cut them to near zero, the one thing you're going to do is light a match under the property market, and we're going to see house prices. We're going to see commercial property respond to that. So we shouldn't be surprised. And in fact, one of the reasons the central bank here has cut interest rates to near zero is because they wanted to get the property market moving. It's not a bad thing if we all feel a bit wealthier. And if some of the strains on our balance sheets in repaying our home loans are eased by lower interest rates as well. So it's part of the policy response to keep the economy moving. And the other point to note about this is that we tend to think about the Australian housing market as being different, but in reality it isn't. We're just like every other housing market, that when you cut interest rates, they do respond. And I just wanted to highlight these couple of charts here. So they show you on the left-hand side what's happening with mortgage lending, if you like, rapid growth around the world, and the chart on the right-hand side, what's happening with house prices in those same countries. And if you look at the dark blue line there on both of those charts, that's Australia. I look at that chart, and to be honest, the Australian experience, we're kind of sitting in the middle of the pack. There's nothing exceptional about our housing market response when we compare ourselves on that global basis. So it's not as though the Australian market is developing some imbalance that's going to get us in trouble that's different from the rest of the world. Nevertheless, we can't deny the regulators have been concerned about the Australian housing market, and we have seen some tentative steps down the path of what they call macroprudential policy. So this is basically with regulators like APRA try to do things specifically targeting bank balance sheets with the idea that it will take some of the steam out of the market. So we don't need to increase interest rates to get to that outcome. We can do it through other channels as well. And of course, what we have seen happen in recent times is that the regulators have told the banks to increase the interest rate they use when they're assessing whether new borrowers can actually repay their home loans. So the idea is that reduces the amount of money that people can borrow, and if people can borrow less, then we should see some cooling in the housing market as a result. Now, this sort of approach is actually quite different from the last time we tried these macroprudential measures, which was back in 2014, 2017. And what happened back then is that we were worried about there was too much housing lending being done to investors. There was too much going as interest-only loans, and there was too much going to high loan-to-valuation ratio type lending. Well, the chart here shows you what's happening this time around. The fact is, all those areas that regulators worry about are actually declining right now. So the real risk, or the real indication here is, I think, is what the regulators are worried about is not so much what the banks are doing, but what might happen if something happens in the economy that then feeds back into the housing market. And the two areas of worry that would get the banks into trouble would be a negative income shock, or of course if house prices actually fell. Now, as I say, a couple of points to make about those things. As I've already said, the general expectation is that the Australian economy will recover from here as lockdowns end in New South Wales, as they will in Victoria, and as the rest of the economy opens up, including to the rest of the world. We should actually be in for a decent period of economic growth in Australia over the next couple of years. And that's certainly what all the economists at the major banks are expecting right now. It's what the Reserve Bank is expecting, is what underlies government economic forecasts as well. The other thing that stands out about what the big bank economists are saying is that they all expect house prices to rise further. In fact, they all have forecasts around the 20% mark for house price growth this year, and another 6% when we get into 2022. So there's two big things, a negative income shock and a house price fall type shock don't seem very likely right now. When thinking about the impact of what APRA has done, though, there was some interesting information in the Commonwealth Bank's profit announcement a month or so ago. I picked on them mainly because their results are much more up to date than the other big banks, but a couple of bits of information from their results that struck me with what you can see on the two charts here. So the chart on the left-hand side shows you on the Commonwealth Bank's books how many people actually borrow as much as they can. And the answer, when you look at this chart, is on the left-hand side, is about 8%. So basically 92% of Commonwealth Bank borrowers don't borrow as much as the bank is happy to lend them. So to my point of mind is, well, you may be able to borrow less because of these new changes, but the reality is very few people borrow that amount anyway. So I'm not sure that these APRA restrictions are really going to impact on lending or bank profitability. As I heard one person describe them, it was a bit like being thrashed with a wet lettuce leaf. And I can agree with that. The other chart that's particularly interesting is on the right-hand side there. If you just focus on the yellow bars, because that's the latest outcomes, it shows you that a lot of home loan borrowers, and again, as I say, this is Commonwealth Bank data, as interest rates came down, they just kept their loan repayments constant. It's accelerated the rate that they're paying off those home loans, and 34% of Commonwealth Bank borrowers are more than 2 years ahead in their mortgages. So there's a fair degree of protection there for people with a mortgage and for the banks that lent them that money, courtesy of that particular outcome. We move on to commercial property. Well, again, it's an area the regulators are worried about, and the two areas, of course, that get a lot of attention are what's happening in the office market and the retail market as well. So the regulators tend to worry about the fact that we look at offices on the left-hand side, that valuations are kind of much higher than you would expect given where rents are at the moment. Of course, those rents have fallen because of the shutdown and the like. The point I'd make about that is that most of that lending for offices in recent years has come from foreign banks, and a lot of the purchase activity that's pushed up valuations is actually by foreign buyers. You can see that on the right-hand side panel there. Or the left-hand side panel, right-hand panel, the left-hand side. Again, I think the retail story is pretty much understood. Vacancy rates have increased everywhere, courtesy of what is going on, and there is some risk factors there. Should be receding as economies open up and we return to the shops. Sort of things to watch here, I think, are what you can see on this particular chart. It's a very interesting set of data collected by Google. It seems they really do know where we are at any point in time. And what it's actually showing is our mobility or our visits to workplaces, to retail and recreation places relative to where we were pre-COVID. I just highlight one line on this chart, and that's the top blue line, retail and recreation in New South Wales. Some new data just came out this morning, and that blue line is kicked up quite a bit. So we're seeing a pretty rapid move back towards normal levels of activity in the retail space, much as we saw after previous lockdowns. That continues, and the risks in that kind of retail component of the property market are probably much reduced as a result. Luck has always been part of the Australian story, and the luck for the banks this time around, I think, is what you can see on this particular chart. It shows you who the bank's been lending money to, particularly in the small and medium-sized enterprise space. And the luck is that they're lending to the areas that are highly affected by the pandemic and the lockdown. So the left-hand side panel there, it's a pretty small part of the total. So their exposure to the worst affected parts of the Australian economy is pretty low. And obviously that's not a bad thing in the current environment. I'd also just highlight, as we're passing through these couple of charts, it shows you what's happening with business insolvencies and personal bankruptcies. And the somewhat surprising outcome, given what's going on, is that in both cases, these have fallen to very low levels. It's partly because policymakers have been aware of the risks, and they've been prepared to do something to limit those bankruptcies and insolvencies. So maybe it's just a lagging indicator that we will see these pick up over time, and it will become a problem for the economy and the financial system. But the message I really take from these two charts is that policymakers actually know what to do in these sort of circumstances, and they're not afraid to do it. And that applies today, and that will apply in the future if this does become an issue. So I would actually see this as a pretty positive sign when you're thinking about financial system stability. And look, just finally to end up on my section here, because we do need something to worry about. And what has been interesting in recent years is the amount of attention the regulators are increasingly paying to cybercrime. And you can get a kind of little bit of a snapshot of what's happening with the financial sector and their kind of hits from cyber criminals in the last couple of years. And it's quite noticeable. The Reserve Bank only a few weeks ago made the point that, to quote them, a significant cyber event that has the potential for systemic implications is at some point inevitable. Now, I don't like to finish on a negative note, but clearly these are the sort of risks that we should all have in the back of our minds. But overall, the financial system looks to be, as it has been for a long time now, a well-regulated sector of the Australian economy that also remains pretty profitable overall. So I'll stop there, and I'll hand over to Mark.
Well, thanks, Michael, for that very comprehensive sector review. Mark, over to you for some comments on the current leveraged equity loan investment opportunity.
Yeah, sure. Thanks, Alex, and thanks to Michael for such a comprehensive update. So for us, tying in Michael's reasonably constructive views on the banking sector into an efficient way for our investors to take potential upside exposure for the bank stocks, as well as gaining the benefits of the expected strong dividends, as well as franking credits going along with those dividends, has really been our focus in the current offering that we have on the table for you with our limited recourse equity loan solutions. So we currently have essentially 3 versions of these bank investment structures open for investment on our site. That is, we have one which takes leverage exposure to ANZ, one that takes exposure to NAB, and of course one for Westpac. The only reason we haven't included CBA is simply because their dividend cycle is at different times of the year to the other 3. We also are deliberately targeting this timing now with the investment closing dates for the 3 of them being in 8 days' time, that is on the 29th of October. And this is because their ex-dividend dates are scheduled for the following week. We've also deliberately made these note structures to be 7 months long. So it's a 7-month investment to you, whereby the investors can receive the expected 2 dividends that we expect to occur in that 7-month period, plus take advantage of those franking credits that go with those dividends. The franking credits do apply here because the stock is essentially held for more than the 45-day holding period requirement from the first ex-dividend date in November. And for the second dividend, it is held for longer than that 45-day requirement prior to the ex-dividend date. So that's why the franking credits can be applicable. The other priority for us when structuring these bank exposure notes is really two things. One being coming up with a structure that allows you to put a much smaller amount of capital potentially down into the investment than the actual exposure of the bank stock that you are seeking to achieve. That is, by way of an example, if an investor wants to have a $1 million exposure to, say, ANZ, they don't necessarily want to have to put down their full $1 million of their capital into the stock for the next 7-month period. So instead, the purpose of these leveraged equity loan notes are to allow an investor to take that $1 million exposure, if that was their desired amount, and be only having to put down around $113,000 of capital based on the most recent pricing. That is, the structure provides leverage at about 8.5 times. Likewise, if an investor wants to put down a small amount of capital, if I use an example of, say, an investor looking to put down just a bit over $10,000 for an $11,370 outlay of capital, according to the last pricing, it would be providing them $100,000 worth of exposure to the stock. The other priority for us, particularly given these notes are taking a leveraged exposure, is to have that downside risk be controlled and be fully known. That is, as you would all know, when you are taking leverage on any equity position, it also means your potential losses, if the stock goes down in value, are essentially magnified or multiplied. So this structure has been specifically designed with downside protection, whereby if the stock has gone down in value in 7 months' time when the note matures, the investor essentially can't lose any further capital than the amount that they put in the first instance. That is, it's a non-recourse lending structure. You do, of course, still receive the 2 dividends that are likely, subject and franking credits that go along with those dividends, subject to your own tax circumstances, whether you can utilise those franking credits, of course. And finally, also have the ability to claim a tax deduction for the interest component of this particular structure. So within the cost of the structure, there is an interest component which can be claimed as a tax deduction. So in a worst case scenario where the stock has fallen in value, the amount of capital that you have lost through the note structure has been partially offset by those dividends that you've received. It's also been partially offset by the usage of the franking credits, assuming you're able to utilise them, and partially offset by the tax deductibility nature of the interest component. This all essentially decreases the worst case scenario outcome in these notes. If, of course, the banks really surprised us all and decided to not pay a dividend, like they did choose not to for a brief period there in 2020, really when we're in the heart of the worst of the pandemic, this is, of course, a risk to the financial outcome of the note if that was to occur. But obviously, you heard all Michael's update there, comprehensive update, and the banks are in a extremely strong capital position. The final comments I would make are around the tax efficiency of this structure. Essentially, an investor could alternatively go and buy a 7-month call option themselves on a bank stock. They would therefore be paying an option premium to do that, and then they would be receiving any upside in the bank stock at the end of the period. This is what is actually built within our note structure. However, the big difference here is the owner of that single call option wouldn't be entitled to the dividends. They therefore wouldn't be entitled to the franking credits associated with the dividends through that period as well. So one of the key strengths of this structured note approach is the tax efficiency that comes with still being entitled to those dividends, and also being able to claim an interest tax deduction, subject to your own individual tax circumstances, of course, for the interest component that's embedded in that note. The RBA actually specifies and publishes the deductible rate, which currently sits at 6.1%. So essentially, when the note structure is used, the investor can be claiming interest cost deductibility within that initial payment up to that 6.1%. I have to note here that that everyone's tax positions are different, of course, and I'm not permitted to give tax-specific advice, but keeping it very simple for you, for the current pricing coming out a touch above 18% for the total note structure, essentially a simple way to think of it could be that about a third of your payment is likely to have that tax deductibility to it. So in summary, before I hand back over to Alex for any questions for Michael or myself, we view the 7-month leveraged equity loan solutions we have built for you, our investors, is a logical way to take the potential upside in the banking stocks. It utilises some leverage in a controlled manner where the downside is known from the outset. And it still takes the benefit of those exposures to the bank's dividends, and of course the franking credits that come along with those dividends. So that's it from me, and I'll hand back over to Alex.
Oh, well, great. Well, thanks, Mark. And I'd like to invite investors to submit any questions through the portal. We have received a few through. First one for Mark. Mark, you mentioned the tax efficiency of this particular solution. Is there a tax ruling?
We've got a tax opinion, so not a ruling, but an opinion. We are more than happy to share that with any investors that would like to receive it.
Okay, terrific. And a follow-on question: are these instruments available for SMSF investment?
Yes, is the answer to that question. SMSFs can take exposure to this structure. We have structured in a way that we know is appropriate for SMSFs. It is, I guess, one of the few ways that an SMSF investor can utilise leverage within an SMSF investment. It's very, very difficult to take leverage in generally in SMSF investments, but it would be one of the few ways an investor could utilise some leverage in their fund.
Right. And a question for Michael. Michael, how would you expect the Aussie banks to respond in an inflationary environment?
I think the banks actually find that kind of useful because what you would expect in an inflationary environment is that the yield curve steepens. And particularly in the current environment where our central bank, the RBA, has made it very clear that they don't think we're going to be in a situation where they'll be lifting short-term interest rates before we get to 2024 at the earliest. So we do see an increased inflation. You can pretty much guarantee that financial markets will push up those longer-term interest rates. The Australian yield curve steepens. And banks tend to do pretty well in that environment, mainly because they're borrowing short and lending long, so they can kind of roll along the yield curve if you like. So definitely positively sloped yield curves are favourable for banks. And again, it's one of the reasons why the Reserve Bank has been so keen to keep short-term interest rates as close to zero as they can get them, and why they actually extended that out, not just from short-term interest rates, but all the way out to 3-year interest rates as well. That's why they put in place things like that term funding facility where the banks could borrow 3-year money at 0.1%. So as I say, that kind of environment is actually good for bank profits in a nominal sense at least.
Oh, terrific. And a final question that's come through for Mark. Mark, is this structure able to be utilised by investors for other stocks, CBA or other sectors?
Yes, it can be, and if an investor has a specific stock outside of what we're doing here with these three major banks that they want us to price something up, by all means, please just reach out to your iPartners representative, and we can work on that. So yes, the answer is yes. It does work very effectively, generally with higher dividend paying stocks, hence why the major banks are very, very appropriate here. You've also got to give some thought around the dividend cycle from a date point of view. Per my comment, whereby CBA is on a different date cycle. But yes, if an investor has any particular stock that they would like something similar built for, subject to sizing and the individual stock, yes, by all means we can.
Oh, well, terrific. Well, thank you both, Michael and Mark, and thanks everyone for joining us on today's Talking Alternatives webinar. We hope you found this a useful session. For our investors, we expect this opportunity to close on the 29th of October. So we would encourage you to get in touch to secure an allocation or to log on to our platform to do so. Investors can participate in the leveraged equity loan opportunity from a minimum of $5,000 through the iPartners platform. So please reach out to your iPartners representative or contact us at service@ipartners.com.au for information. Thank you.
Thank you.
Thank you.